The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. The alternative investment landscape in 2025 is being reshaped by a convergence of technological innovation, shifting regulatory frameworks, and evolving investor demands. From the rise of tokenized real-world assets and the surge in private credit to the increasing influence of AI and a deeper focus on measurable impact, the sector is navigating new opportunities and challenges. As geopolitical uncertainties persist and retail investors gain greater access to alternatives, the dynamics of this space are rapidly changing. How are these trends influencing investment strategies? What are the key themes to watch out for in the alternative space? What risks and rewards lie ahead for investors embracing these themes? Well, to find out more, joining me now here in the studio is Gerald Gan, who is the Deputy Chief Investment Officer at Reed Capital Partners. Gerald, welcome back to the show.
All right, thank you. Glad to be back.
Thank you so much for joining us. Well, Gerald, as the alternative investment space continues to evolve rapidly, certain themes are gaining momentum driven by technology, regulation, and shifting investor priorities. So to start, what alternative investment themes do you see gaining the most traction this year?
Well, I think one of the notable types of investments that are getting quite a bit of traction, I would say, is private credit. Okay, but I think in private credit, we have to really subdivide them to two different categories. Like traditionally speaking, a lot of others institutional investors, they like private credit as well, but usually those are long tenor kinds of investments. All right, nowadays, interestingly, there are more and more private credit funds that are actually coming in to promote short tenor duration kind of investments, meaning to say that those that they issue out to companies are actually those receivables. All right, so these are some of the collaterals that we are seeing within private credit that is gaining a lot of traction this year itself.
Okay, we'll talk more about private credit in just a bit, but let's explore the theme of blockchain technology first. I mean, it's enabling the tokenization of real-world assets, allowing for fractional ownership and potentially greater liquidity in markets like real estate, art, and of course, private credit. So how is tokenization changing the alternative investment landscape here? What challenges and opportunities do you foresee?
Okay, now before I go into, of course, the challenges and opportunities, I just want to give a glimpse of a little bit of a brief introduction on what's tokenization, right, to the listeners. So basically, a tokenization, it's simply just a contract or smart contract, right? So, or you can say it's what I call a digital form of a ownership, all right, similar to shares. So what we see over here in recent times is that tokenization has started to be emplaced in a lot of different types of asset classes, right? As you've mentioned, it has started to go into private credit, private equity, even on real estate itself. So real estate in particular is actually gaining a lot of traction, right, to be tokenized. So what do I mean by that? So it means that anyone right now can own a small piece of a house or an apartment. So we can get a part of a share or to be able to invest where traditionally real estate has always been a big token item, right? A big asset in terms of pricing. So it's hard for people to get accessibility within it. But of course, in times like this, what we see right now is that more and more young people are able to get access as low as $100. You can actually get a part of a share of a real estate. All right, so this in itself is, of course, number one, allows more accessibility in investments for individuals. All right, so that's very important. And number two, it allows more liquidity, right? So liquidity in itself is quite interesting here. So we know that real estate, traditionally speaking, has always been quite illiquid, right? It's a big ticket item. It's hard to sell. Usually the transactions are not very frequent, all right? It's hard to find what's the real market value of a certain apartment. But of course, right now with tokenization, it can be traded very liquidly in the markets. So with that, we can actually see what's the price of a certain type of apartment that someone is looking for through this platform. Right? So that's one thing. Of course, we do have another kind of opportunity, which is another good benefit, which is low cost. Okay, we know smart contracts are very easy to be created. So it kind of save a lot of cost on auditing, legal, and contracts. So that's one thing. So now let's move on to challenges. I think the biggest challenges over here is the one and biggest one, which I think it's a problem, is speculation. right? So we know that right now, let's say, for example, today, someone buys a token from someone else, owning a part of a share of a real estate. Now, this becomes an issue because it's so liquid to the point that anyone else can actually buy and sell very quickly. And that can actually bring up prices. Now, considering that if we start to see this happening in Singapore, it's not a good sign, right? So we know that housing prices in Singapore is really very expensive. So if this continues to happen, and of course with this easy accessible tokenization kind of a platform for people to invest and trade starts to happen, it's going to be a big problem for housing prices.
Definitely.
That's one of the problems, yeah.
Okay, well, let's dive into private credit here. I mean, that was the key theme that you are looking at for in 2025 in the alternate investment space. Well, private credit has filled a lending gap left by banks and has become a popular alternative for yield-seeking investors. So with this rapid growth, do you expect private credit to continue this momentum in 2025? What risks should investors keep in mind, though?
Yes, I think right now we should be expecting. All right, in general, what we see over here in terms of the overall trend in private credit is that, yes, because it has started to be more accessible to individual investors, and we think that the momentum is going to be strong, not just this year, but in the years down the road as well. All right. One thing over here, which is good in the sense that more and more companies, right, so smaller companies that are not so strong in terms of credit rating, is able to get funding through all these platforms, right? Private credit lending and whatnot. So this in itself, why is this so? Because over the years, as we know that for those who are working in banking, we know that the Basel is actually a very strict regulatory body that actually governs all banks in the world.
Right.
So it becomes a problem. Why? Because over time, banks are more unwilling to borrow money, or rather, lend money to companies that are smaller in size, and of course, at the same time, lower credit rating. So there's a massive gap over here that private credit companies are able to fill up this gap. So which in itself is actually giving opportunities to new investors, more so for individual investors to start to come in and invest in itself. So we over time, we will see more and more traction on this, all right? And of course, limited partners wise, because we do have general partners and limited partners. So in terms of investors, we will start to see that shift from traditional institutional investors, from pension funds, endowments, even sovereign wealth funds, to more into individual investors.
Okay.
All right.
Okay. Well, of course, the theme of AI can't be overlooked as well, not just in public markets, but also private markets, because AI is increasingly being applied to streamline due diligence and portfolio management in private markets. So how is AI transforming these processes within alternative investments? And are there any limitations or concerns about relying on AI in this space?
I think right now AI is still quite at its infancy stage, in my opinion. All right, but of course, in this last couple of years, AI has grown to the point that it can do a lot of things for us, especially for investment managers. Now, first of all, let's look at due diligence. I think that's very important, right? So due diligence, before AI, due diligence actually costs a lot of money, all right? To make sure that all these documents are legitimate, things like that. And of course, to look at those financial statements, those are numbers that are legitimate as well. So usually this kind of process takes up a lot of time and cost for companies. All right, so of course, right now with AI, all you need to do is just apply the AI, all right? Just show a bunch of all these documents inside, and they can actually do the due diligence for you. All right. But of course, it's still limited in the sense that AI can only be effective in terms of what information you put inside. All right. So it's still limited in this space. All right. So these are the things that we need to look out for as well. But of course, another thing which is quite interesting over here is that AI is able to scan news, social medias, and a lot of different alternative data sources, which is interesting because nowadays, right now, due diligence are getting more and more advanced in the sense that a lot of people who wants to get around regulatory rules tend to have a lot more creativity. All right, for that to not happen, all right, so usually AI is able to source out all these alternative data and then kind of come up with red flags to see whether or not all this basically ensure that due diligence is done effectively.
Right. And I also want to talk about the theme of ESG as well. I mean, those factors remain central to investor decision making, but the focus is shifting toward more measurable impact. So how is the ESG landscape evolving in alternatives, and what does the concept of Impact 2.0 mean for asset managers and investors?
Okay, so I think this ESG it's a concept that many governments in the world started implementing year 2004. All right. So over time, it kind of lost a bit of its traction for a bit because why? Let's put ourselves in the investment space, right? So a lot of people in recent years, even the banks has advocated, let's do ESG, right? It's good. The returns are a lot better. But to be honest, in terms of the data that what we see, historical data, don't really suggest that ESG has bring up excess returns for clients, for investors. So that's one thing in itself. But of course, ESG impact, let's talk about this impact as well, which is 1.0 and 2.0, right? So impact 1.0 is what we saw at the start of 2004, which is to try to shift away investments to cleaner energy, for example, all right? That actually helps the environment. Of course, social, and of course, governance, right? Better governance and whatnot. All right. So this in itself, it's more of a prevention move, right? So right now, Impact 2.0, it's a shift into more active role, right? So something that's more active for investment managers as well. It's not just avoiding bad investments. They are not ESG regulated. Does not score well in ESG measures, all right? But also at the same time, to be able to be an activist. All right, so investment managers are now trying to be more active in a sense that they want to rein into companies. Of course, those big money that are invested in those companies allow us to have those veto powers, right? For example, if let's say I'm an investment manager, I get a veto power into a company and actually can make notable changes in the company to make things better, to provide solutions. Right? That's what we call Impact 2.0. And I think moving forward, this is going to be a big trend. But to me right now, to be honest, I'm quite skeptical whether or not it's going to play out very soon. I think it's going to be a very, very long period of time for Impact 2.0 to be really implemented or be accepted by the public.
Interesting. Well, also, given ongoing geopolitical tensions and market volatility, many investors are also looking for alternative investments to hedge risks, right? How much are geopolitical tensions and market volatility weighing on alternatives, though?
Honestly, it's hard to tell, right? So I think in a previous show, I did talk about this, what you call alternative investments being illiquid, all right? So in that sense, usually it's hard for us, at least for an investment manager, to tell how much has been priced in the risk into alternative investments because data is not sufficient, right, in this space. But of course, in general, if you want to look at the fundamentals, all right, a fundamental perspective suggests that it's not just the public companies that will be affected by all these geopolitical tensions, but private companies as well. It's just that it's not that transparent, right? The real damage has been done, but of course, we don't know how much is the damage. But all we know is that, yes, there will still be a certain amount of geopolitical risk that is applied within alternatives. But of course, with what you ask, this is quite interesting in the sense that because right now we are moving into the world of multipolarity, right? With Donald Trump imposing all this very hostile foreign policies, it's really, really crucial, for listeners, for investors themselves, to really pinpoint and understand better what are the alternative investments they are getting themselves into. All right, so it's not all alternative investments can always provide the best returns compared to the public market, right? Sometimes it can be even worse. So these are the things that we need to look at very, very closely.
Okay. Then overall, what are some, emerging sectors within alternatives that investors should keep an eye on in 2025?
Well, emerging, I would say the typical areas such as renewable energy, right? That's one of the few things that I think it still continues to be very attractive within the investment space. All right. Another thing that probably it's not being looked at very, very closely is water. Now, water is something I think a lot of people have taken, don't really look at it as something very important, but even though it's what we need to survive. But recent times, what we've been seeing is that we've started to see opportunities in Middle East. In the Middle East, they are starting to bring up, how do I say this? Because we know that in the Gulf states, water is actually not ample. All right. And what we are starting to see is that people are starting to, or rather entrepreneurs are starting, or engineers are starting to look at water that's down right below the seabed.
Okay.
Right, these are some of the very, very interesting examples that we are starting to see, and it's gaining quite a bit of traction. All right, so just a bit of brief information about this, a brief detail about this is that, so what we know right now, at least from what I read, is that there are actually a new source of water below the seabed that has been untapped by humans. And the water content has a lot more, I think 10 to 20 times more nutrients than the water that we are drinking on a daily basis.
Some business
so these are
idea
some
here.
of the things that we're looking at. Very interesting projects going on. And I think these are some of the areas that will start to be very, very interesting.
Very interesting. Well, on that note, though, are there any potential risks or headwinds that investors in alternatives should be especially cautious about in this year?
Well, I would say it still goes back to geopolitical risk. Right? So I think this year in itself, the uncertainty is very high, right? Not so much from fundamentals, but rather from geopolitics. All right? We have a lot of all these countries are coming up to be more protectionistic, very nationalistic. These are not good for businesses, right? So we know, of course, back to this is that let's look at alternative investments related to companies like private equity and private credit. These guys usually need trade to happen, right? So for private credit, for example, usually the companies that our investment firms invest in are usually companies that trade around the world.
Okay.
All right. So when we start to see that global trade slows down, which is already slowing down, all right, albeit numbers are showing otherwise in official sources from certain countries, we believe that this is going to be a big impact for the private credit space. Right. So even though, like I mentioned earlier on, the collaterals are usually those very, very liquid receivables. All right. Risks are low. But do not forget, there are still risks over here. Is that if those goods are not being able to be shipped, there are a lot of losses that will be incurred over there. And then there will become a problem for all these private credit companies to recoup their losses.
I mean, we discussed several themes in the alternative investment space in our conversation. But before we let you go here, Gerald, how should family offices and institutional investors be adjusting their alternative investment strategies to stay ahead of these themes?
Well, let's say, for example, family office. I think because we do manage quite a few family offices as well, our advice to them is stay invested, right? Typical, quite a cliche advice, but yes, stay invested, especially when you want to, because more and more family offices are interested in alternatives, right? They want to increase their allocation to alternatives. We think it's a good thing because on a longer term perspective, like usually 10 to 20 years down the road, it actually provides a higher form of return, right? That is good. But of course, provided that the money can be, the investment horizon is long as well. So what I would say right now is that stay invested. So all in all, albeit it's still very risky in the short term, but I think moving forward, we might see quite a bit of great performance in our alternative space in general.
All right. Well, stay invested. Well, thank you so much, Gerald, for joining me today. Thank you. That was Gerald Gan, who's the Deputy Chief Investment Officer at Reed Capital Partners. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.